prior to the margin hikes, if you had $21,000 in your margin account, just cash sitting in an account, that would give you the ability to go on margin and control 5,000 ounces of silver.
Right.
One contract. $300,000 of silver at $60, with 21,000 in your account, that's some nice leverage. Well, they hiked the margins twice. The second time by 30%, the first time by like 10 or 12%. A big hike, right? And normally that just destroys the rally, and it has in years past. Literally kneecapped it, never came back. You look at 2011, they raised margins, and it took, what did it take? 15 years to come back. Not this time. So let's talk about what it did, because what that means is, and the second one was on December 26th, so the day after Christmas, you got a margin call where they said, listen, if you don't deposit 30% more margin, and again, you're only talking $3,000 or whatever, but if you have a dozen contracts or more, you got to come up with that money. 36,000 right now, boom.
Right.
Or they will liquidate your and unwind your account. So you have forced liquidations. If you have 30 contracts, maybe you got to sell 10 of them to cover. Well, that selling drops the price, which creates more stress on people who are on margin. These are the big institutional banks and traders that say, these guys think they're so smart, they can't play in this sandbox. Their checkbook's not big enough. So let's just squeeze them with raising the margins. Maybe we'll short the price, drive it down a little bit, and they will force liquidate, which it did. And you saw that. And you have the big boys and girls sitting there with their hands wide open like this saying, thank you very much. I will stand for delivery. I'll take all of that on the cheap. Big money. They don't care about margin. So when the price gets hammered by the smaller people that are on margin, you have these guys sitting right here. And what do you know? Silver's climbing back up again. And this is what we would expect to see, I think, in this market where they are shaking the bushes, pulling out all of the weak hands or those on leverage, but nothing's changed. Nothing at all. At the same time, before we get into questions, let's just talk about what's happening right now. You have what's called the January effect, where you have hedge funds that need to redeploy money. So we would expect that to be very bullish. Anytime the West tries to step on the price, you have Asia sitting there saying, thank you very much, I will buy it. They're buying. There's a what's called an arbitrage spread right now between the US and China, where China's price is substantially higher than it is here. So you get the traders say, well, geez, if I were to buy it here and sell it there, the physical, buy the paper here, sell the physical there, I'll make a lot of money. And they do. That physical never comes back, by the way. And then on the other side, which could create volatility, we have rebalancing, right? Silver has gotten so far out of whack, and gold, with allocation models, the Bloomberg commodity index. It will have to they'll have to revalue, because gold and silver have become inordinately outsized in terms of their weight in the portfolio. So they're like, damn it, I really don't want to sell that, but I have to legally. Well, guess who's going to be sitting there waiting to gather it up at pennies on the dollar or whatever, and that will be all of the big traders who have been doing this for the last 13 months. And one last thing, just talking about the 13 months and all of these deliveries, there's one thing that I just want to mention, and we'll talk about deliveries as people ask about them. But if we look at just in the first 3 days of January, the first 3 days of the January delivery, by the way, December was an all-time high, record high for deliveries in December, 62.875 million ounces, 62,875,000 ounces of silver, all-time record high for December. 12,575 contracts stood for delivery in December. Well, what about January, right? Well, let's look at January.
That's about 10%, almost 10% of the annual.
It's insane,
that we do every year.
Now let's look at January. So far in January, and I read this last night, so it would be 4 days now, but with only three delivery days old, there have already been 4,249 gold contracts plus 3,596 silver contracts issued and stopped. That means they're being delivered. That's 424,900 troy ounces of gold times 4,200. You're like, what, 1.6 billion or something? And 17,980,000 ounces of silver in 3 days.
Wow.
You're talking 18 million ounces of silver. This is all you need to know. That's it. The biggest money in the world is right here saying, yeah, bring it in, 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 bring it in. Forget about the noise. Don't be distracted by the noise. It's going to be volatile like a heart monitor because of the January effect, because of the rebalancing, because of the shorts that are trapped, because of all of this and the systemic contagion nature. And if it's true what we're hearing about the JP Morgan letter that just came out and the Morgan Stanley letter, which both would make sense to me, why wouldn't they just buy it all? Because you cut off your nose to spite your face. But if you do it little by little, here and here and here and here and all over here and over there and through proxy banks, and don't do too much, don't become obvious.
Andy Schectman. This is not a normal price cycle. It is the breakdown of a decades-old control system. The chain reaction started with aggressive margin hikes in late December. With just $21,000 in margin, a trader could control $300,000 worth of silver. When exchanges raised margin requirements by over 40% in 2 sudden moves, forced liquidations followed. Smaller traders and leveraged funds were pushed out. Prices dropped briefly, but instead of collapsing as they always have in past silver cycles, physical buyers stepped in immediately and absorbed everything. That is the first red flag. In 2011, margin hikes crushed silver for more than a decade. This time, the price rebounded almost instantly. That tells you who is buying. Not hedge funds, not retail traders, but institutions and sovereign scale money that does not use leverage and does not care about margin calls. At the same time, arbitrage between China and the US is pulling physical silver out of Western vaults. Silver trades at a higher price in Asia than in New York, so traders buy paper silver in the US, take delivery, ship it to Asia, and sell it for a profit. That metal does not come back. This is a one-way drain. Then come the delivery numbers. In December alone.
Then all of a sudden, that little by little becomes all at once.
Well, there's one elephant in the room that has little by little by little, and then all at once.
What's that?
Well, we're talking about JP Morgan,
Yeah.
about what we're talking about, a little bit of a bait and switch, I think a lot of people are really calling it. And look, there is so much information. I'm sure that many of our viewers
I don't know if if we're talking about the same JP Morgan memorandum.
No, we're talking about different, but I'm talking about what we were hearing last week with regard to the Asian guy AI.
Okay, well,
That's
I
what
went
I'm
back.
talking about.
And forget about Mr. Asian guy, because I think he's great. But that article I talked about 3 weeks ago before we went on vacation, the Economic Times had an article, to your point, what you're talking about, saying JP Morgan flip-flopped. They're now net long. They've covered a 200 million ounce short position. They bought 21 million ounces of physical in 6 weeks. And the rest of the U.S. banks are more or less long. Now, this would fit hand in glove with what Tom Luongo says, that Tom Luongo has a very interesting fresh take saying that Trump is out to get the European aristocrats that now, again, this is Tom's view, and I think it's compelling, that he thinks they're responsible for the election interference and the color revolution that we saw in the previous administration, which would have all been, in his mind, out to keep him from taking office. Now, right, wrong, or indifferent, if that is the case, wait till you hear what the Asian guy said today about JP Morgan.
I didn't get to listen to him today.
Okay, well, first of all, if the U.S. banks are net long, first of all, he came out the other day and said Morgan Stanley had leaked a memorandum telling all of their institutional traders to close out all silver positions by the end of the month. All of them.
Both long and short.
Yes.
Okay.
Get out. Now, I don't know how I feel about that one, but there is one today, and he says it's validated and verified. Now, I can't verify it, but he said, JP Morgan says, exit your positions by January 31st. After that, we will no longer allow delivery. We will only go to
62.8 million ounces of silver stood for delivery, the highest monthly total in COMEX history. In just the first 3 days of January, nearly 18 million more ounces of silver and over 400,000 ounces of gold were demanded for physical delivery. That is institutional money saying one thing: bring us the metal. This is not speculation. This is extraction. Now comes the most alarming part. According to multiple industry sources cited by Schectman, Morgan Stanley allegedly issued a memorandum instructing institutional clients to exit all silver positions by the end of the month. More shocking still, JP Morgan is rumored to have told its clients that after January 31st, physical delivery will no longer be allowed, only cash settlement. If true, this means something extraordinary. The banks know the metal is running out. When a market moves from physical settlement to cash settlement, it is because delivery risk has become unmanageable. It means too many people want the metal and not enough metal exists to fulfill the contracts. That is the definition of systemic stress. And it gets worse. JP Morgan reportedly flipped from being massively short silver to becoming net long, covering a 200 million ounce short position and acquiring more than 21 million ounces of physical silver in just 6 weeks. Other U.S. banks have reportedly done the same. In other words, the banks that suppressed silver for decades are now buying it for over 30 years. A small group of Western banks held the largest concentrated short position in the history of commodity trading in silver. They used paper contracts in New York to drive the price down while quietly accumulating metal in London through off-exchange mechanisms. That system depended on nobody demanding delivery. Now China, India, Russia, Saudi Arabia, and the global south have figured it out. They are standing for delivery. This is how price suppression ends. Not with a chart breakout, but with physical withdrawal at the same time. ETFs like SLV and GLD are being exposed. Their prospectuses allow sub-custodians, no inspections, no guaranteed bar integrity, cash settlement in case of fraud, and no physical redemption for investors. If metal disappears, the investors get paid in paper at yesterday's price, while the metal goes somewhere else. This is why banks want clients out of physical silver contracts and into ETFs. ETFs cannot demand delivery. They cannot break the system, but physical silver can. Schectman's conclusion is clear. When the metal is gone, price becomes irrelevant. Not because it goes up, but because it no longer exists for sale. This is not a rally. This is a drain.